Hello all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on Indian airports gearing up for smooth takeoff. We sincerely appreciate you taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. G.R.K. Babu, Chief Financial Officer at Airport Division GMR Airports Limited. Mr. Rakesh Tiwary, Chief Financial Officer at Adani Airport Holdings Limited. Mr. Shameek, Head of Debt Capital Market at ICICI Securities Primary Dealership Limited. This session will be moderated by Mr. Maulesh Desai, Director at CareEdge Ratings. We will commence the session with the presentation by Palak Vyas, Associate Director, and Urvesh Patel, Lead Analyst at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Palak to make the presentation.
Thank you, Mamta. Good evening and a very warm welcome to all the participants and esteemed panelists for today's webinar, Indian Airports Gearing Up for a Smooth Takeoff. We shall begin the presentation with key messages. CareEdge Ratings estimates passenger traffic to grow at a CAGR of 9% over FY24 to FY27 on a high base. International traffic shall outpace the domestic traffic growth over FY24 to FY27. CareEdge Ratings expects capital outlay to increase by 25% to rupees 1 lakh crore over FY26 to FY30, leading to funding opportunities of about 70,000 to 75,000 crores. Aero revenue for 11 private airport players is expected to grow at a CAGR of 42% over FY24 to FY27, while non-aero revenue is expected to grow at a CAGR of 15% over the same period. CareEdge Ratings expects leverage to peak out during FY25 with expected improvement to below 6 times from FY26 onwards. The outlook for the sector is positive. Moving on with the agenda, we shall cover the key topics in 4 sections: passenger traffic analysis and key growth drivers, capex and forecast, regulatory landscape, followed by an overview of combined financial performance of 11 major private airports. So now let's begin the session by analyzing the traffic at Indian airports in comparison to the global trend. As seen in the exhibit, Indian airport share in global airport traffic has increased from 3% in calendar year 2015 to approximately 5% in calendar year 2022, and Indian airports shall continue to handle steady share of global traffic estimated at about 4% for calendar year 2024. The global traffic has fully recovered in calendar year 2024, while India's recovery was relatively quicker, reaching almost pre-COVID levels in calendar year 2023. As per ITA's air connectivity ranking, India's rank has steadily improved from 9th in 2009 to 4th in 2019, only behind USA, China, and Japan. Additionally, India is the third largest aviation market after USA and China, which bolsters investor confidence for the sector. In this context, now let's analyze India's air traffic recovery post-pandemic and medium-term growth trajectory. As seen from the Exhibit 2, the traffic at Indian Airport witnessed a V-shaped recovery and it registered 1.10 times pre-COVID traffic in FY24. While domestic traffic had almost recovered during FY23, international traffic achieved full recovery only in FY24, reaching 1.04 times the pre-COVID level. CARE Ratings estimates passenger traffic to surpass 400 million during FY25. However, passenger traffic is expected to be 5% lower than the earlier estimates due to delay in delivery of aircraft, adverse weather condition, which shall be partly offset by Mahakumbh impact in Q4 FY25. As per CareEdge Ratings estimate, passenger traffic is slated to grow at a CAGR of 9% to reach about 485 million passengers during FY27. In CARE Ratings' opinion, international passenger traffic is expected to grow at a higher rate due to slated delivery of wide-bodied aircraft from FY26 onwards, while domestic traffic shall continue to grow at a steady pace despite higher base. Now, moving on to the next slide, let's have a look at the share of the metro versus non-metro airports in traffic distribution. As we see from the exhibit 3, the share of the traffic at the non-metro airport has increased from 32% in FY15 to about 40% in FY24, signaling a faster growth at non-metro airports. This trend continued even for 9-month FY25. CareEdge Rating estimates this trend to continue with introduction of Udan 2, which shall act as a catalyst for increased connectivity to non-metro cities. Now let us glance through the macroeconomic growth propellers. As seen in the Exhibit 4, historically, passenger traffic grew at 2.15x India's GDP CAGR from FY16 to FY19. However, for FY25 and 26, it is expected to moderate to 1.3x to 1.4x only due to higher traffic base of FY24. Nevertheless, India's economic landscape is catalyzed by favorable demographics boosting largest working population, rising income levels, and rising propensity to spend. As depicted in Exhibit 5, India is expected to witness a structural shift in its household income profile. As per World Economic Forum, low-income household in India will reduce significantly from 69% in 2005 to 15% in 2030, indicating shift towards upper income, which augurs well for discretionary spending like travel. The increase in the spending towards travel is also corroborated from the Exhibit 6. As per the RBI data, under the liberalized remittance scheme, Indians spent close to about 7 billion US dollars on international travel in FY20, which more than doubled to 17 billion US dollars in FY24. Now let's look at the infra-led growth drivers. The number of operational airports in India doubled from 74 in 2014 to 157 in 2024. Government has a target of 230 operational airports by 2030. This is besides capacity augmentation at existing operational airports. Large orders placed by domestic airline is expected to ease supply chain bottlenecks. However, timely delivery of the fleet shall remain crucial amidst rising travel demand. Thrust on the greenfield and brownfield expansion of airports with capex outlay of about 1 lakh crore is also positive for the sector. As per the economic survey for 2025 and 26, Indian airport operators, including Airport Authority of India, have incurred capex of about 80,000 crores over FY21 to 9-month FY25, of which 42% of the capex was towards building greenfield airports at 4 locations. Going ahead, CARE Ratings estimates capital outlay to increase by 25% over FY26 to 30 to 1 lakh crore, led by brownfield expansion, indicating funding opportunities of 70,000 to 75,000 crores. 2 greenfield airports with aggregate project cost of about 25,000 crores are slated to commence operation from Q1 FY26. It is pertinent to mention that 20% of this capex is towards city side and non-aero capex. Now let's move on to India's regulatory landscape. The regulatory return on aero assets with a hybrid till structure involving true up and true down of the revenue takes care of traffic fluctuation at the time of subsequent tariff determination process. There is an evaluation of well-defined regulatory environment in India with a mature tariff setting process. Favorable changes have also been incorporated with respect to revenue sharing with the authority linked to per passenger basis as compared to percentage of total revenue in the earlier concessions. Concession period has also been elongated to 50 years from 30 years with provision of extension by 20-30 years stipulated in earlier concession. In Q4 FY25, ERA, in its consultation paper for one of the airport, has approved true-up related to change in the aerotax calculation, which augurs well for the sector. As seen from the Exhibit 12, Over the years, there has been significant reduction in delays in issuance of the tariff order for the existing private airports. While delay in the issuance of first tariff order for newly privatized or a greenfield airport remains a challenge, interim tariff order provides some relief. Now I hand over the session to my colleague Urvesh, who will take us through the study of 11 private airports. Over to you, Urvesh.
Thank you. Let us now have a look at the combined financials of 11 private airports, which handle about 50% of India's total passenger traffic. Talking about the aero revenue, CareEdge Ratings estimates aero revenue to grow at a CAGR of 42% over FY24 to FY27. The expected strong growth is on account of capex approval under regulatory asset base leading to tariff hikes besides passenger growth due to enhanced capacities. Increase in aero revenue during FY24 and 25 is supported by the tariff hike of over 2 times for the 6 airports. CareEdge Ratings estimates aggregate aero revenue of 11 airports to reach around Rs 13,000 crore during FY26 with 56% growth over FY25. The growth will be driven by implementation of tariff hike at one large airport along with the commencement of one greenfield airport in Q1 FY26. Now we shall share our perspective on the non-aero revenue. As seen in Exhibit 14, non-aero revenue has been on an increasing trend in line with the passenger traffic. Going forward, CareEdge Ratings estimates non-aero revenue to grow at a CAGR of 15% over FY24 to FY27, driven by the growth in revenue from duty-free, food and beverages, and lounges. However, non-aero revenue per passenger for international peers is 2 times as compared to Indian airports, indicating significant headroom for a growth in this segment. Unleashing non-aero revenue is directly proportional to increasing international traffic. As per industry sources, average transaction value of Indian airports is largely in line with the global peers. However, penetration rates are relatively lower. Therefore, there is a need to enhance product offerings as per the passenger needs. Also, using technology and analytics, airport operators can predict passenger preferences and enhance customer satisfaction, which can boost the non-aero revenue. Let us now look at the aggregate financial position and estimates for the 11 private airports. CareEdge Ratings estimates PBLDT, that is profit before interest, lease, depreciation and tax, to grow at a CAGR of 38% over FY24 to FY27, led by the healthy growth in aero and non-aero revenues as presented earlier. CareEdge Ratings believes leverage position, that is net debt to PBLDT for assessed airports, is expected to peak at FY25 and improve to below 6 times from FY26 onwards post implementation of tariff hike and benefits of completed capacities. Longer residual concession period of the airports continue to impart financial flexibility to Indian airports. CareEdge Ratings has also observed decline in cost of borrowings for these airports over the years, indicating improved appetite from the lenders. We shall now take a look at the cargo potential, which is acting as a safety net for the sector. Air cargo volumes recorded the CAGR of 9% over FY15 to FY19, and air cargo volumes have seen recovery post-COVID. CareEdge Ratings pegs air cargo volumes to grow at 11% in FY25. CareEdge Ratings believes that government initiatives such as National Logistics Policy and Krishi Udan will help in gaining traction in cargo volumes. In India, belly cargo forms around 80% of air cargo. Large order pipeline of aircrafts, thrust on multimodal logistics, and planned capex for enhancing cargo handling capacity at Indian airports shall provide capacity boost for air cargo going forward. In comparison to global peers, there is a headroom for air cargo as total air cargo handled by India is lower than cargo handled at a single airports such as Hong Kong and Shanghai. Moving on to the last part of the presentation, we will explore whether twin airports are competition or collaboration. To understand the same, let us consider the example of San Francisco. The city has a 3 airports in hub and spoke model. San Francisco International Airport is a hub airport with full service carrier dominance, whereas Auckland and San Jose have a low cost carrier dominance with 82% and 64% LCC traffic respectively. These 3 airports are operating in synergies, serving different segments of customers. With regards to Asia, similar twin airports exist at Bangkok and Jakarta with an annual passenger capacity of about 100 million and 75 million respectively. Notably, GDP per capita for Thailand is USD 7,300 and Indonesia is USD 4,900, which is higher as compared to USD 2,300 for India. Twin operators in the same city exposes traffic diversion risk. However, wider catchment area, higher volume of passenger traffic, higher per capita income, adoption of hub and spoke model, and route development strategies offset the impact of the diversion. Thank you, everyone. Now I will hand over the session to Mamta.
Thank you, Palak and Urvesh. Attendees are requested to key in their question, which we will take up after our panel discussion. Now, may I invite Maulesh Desai to take over the session, please. Maulesh Desai is the Director and Ratings Head at CareEdge Ratings for the transportation sector and handles the portfolio of infrastructure sector companies. He holds a bachelor's degree in engineering, MBA in finance, and CWA. He is also an associate member of ICWAI and a certified associate of the Indian Institute of Bankers. He has more than 18 years of industry experience, including 15.5 years with CareEdge Ratings. Over to you, Maulesh.
Thank you, Mamta, for the quick introduction, and many thanks to Palak and Urvesh for wonderful deck presentation. Good evening and very warm welcome to all the participants in the today's session. Let me begin the session with the famous saying, we are drowning in information but starving for knowledge. And today it is our pleasure to have experts to share their knowledge and discuss threadbare on the airport sector. I would now like to introduce each one of them in alphabetical order. First one is Mr. GRK Babu. Mr. Babu is Chief Financial Officer, Airport Sector of GMR Airports Limited since 2018. He plays pivotal role in strategizing refinancing solutions from domestic and international sources from GMR Airports Limited and its subsidiaries. He has over 35 years of rich experience in handling gamut of responsibilities, including fundraising, treasury, fund management, etc. He joined the GMR Group in October 2007 as a CFO of GMR Hyderabad International Airport Limited and moved to Delhi International Airport Limited as a CFO in August 2011. Mr. GRK Babu is a qualified chartered accountant and company secretary and holds master degree in finance. Warm welcome, Mr. Babu.
Thank you, Maulesh.
Our second panelist for today's session is Mr. Rakesh Tiwary. Mr. Tiwary is Chief Financial Officer of Adani Airport Holdings Limited. Mr. Tiwary is a qualified chartered accountant and company secretary with around 25 years of experience. Prior to joining Adani Group, he worked with various reputed companies like Indian Oil Corporation, Reliance Industries Limited, and JSW Steel Limited. He has worked across various domains in finance, accounts, and commercial functions of business, fundraising, working capital assessment, credit control, taxation, and audit. We welcome you, Mr. Tiwary. Our third eminent panelist for today.
Thank you, Maulesh.
Our third eminent panelist for today's session is Mr. Shameek Ray. Mr. Ray heads the debt capital markets vertical at ICICI Securities Primary Dealership Limited. He has 30 years of experience in working with issuers and investors in debt fundraising as well as investing. Shameek has a keen interest in corporate bond market development and improving corporate bond regulations. He has also worked closely on this with regulators. Very warm welcome, sir, in today's session.
Thank you.
Let's quickly set the context before we begin the discussion. India is third largest aviation market after US and China with rising middle to high income group. Conducive regulatory environment, rising non-aero revenue per passenger, and longer concession also augur well for the airport sector. Yet, some of the critical questions are, what is the scale of investment opportunities in the sector? And what are the challenges in scaling up the cargo and non-passenger revenue? These were some of the questions in our mind when we decided to organize this webinar. I don't want to impose my views on these questions, and I'm confident that our experts will broaden our understanding by providing interesting and valuable insights. So my first question is to you, Mr. Babu. So as seen in the presentation, passenger traffic growth is expected to grow by around 9% during FY25, which is lower than our previous estimates by 12%. So prominent reason are the delay in the delivery of aircrafts and adverse weather conditions. However, if we see the long term, there is a strong pipeline of fleet addition and also capacity addition plan at various airports. So in this context, what is your growth outlook for passenger traffic over FY25 to 27? That is one. And second, can it attain the past GDP multiplier of around 2x? Over to you, sir.
Thank you, Maulesh. If you look at the traffic growth, of course, we consider the GMR airports. Wherever the base is very high, we have grown a little lower, and wherever the base is lower, we have grown higher. So on an average, there is about 9% growth.
Yes.
We are expecting to grow much better than 9% going forward, and we are gearing up for it. Basically, because of the delivery of the aircrafts by the Air India as well as Indigo. And of course, SpiceJet is also becoming strengthening, and Akasa is doing well, and they're also taking the deliveries. Considering the deliveries of the aircrafts, because that are the very critical factor. Without the aircraft's availability, you cannot have the growth further, because most of the ATMs, we look at it, more than 90% of the PLF factor. So considering that, the growth opportunities are very limited unless you have a aircraft deliveries. And to my knowledge, this year, Air India and Indigo put together have taken a delivery about 90 to 100 aircrafts. Of course, some of the old aircrafts are also downed because of the engine problems. We are expecting more than 9% or maybe 10 to 11% growth in the next 2 years. Accordingly, we have also done our planning in our GMR airports. That is as far as the growth is concerned. When it comes to the multiplier effect, yes, always non-aero revenue has a good growth of the GDP. Multiplier effect is always available. But the only thing is you have to have improvement in offerings. If you don't have an improvement in offerings, so you will not able to get. There are two ways. Number one, we look at it the penetration. That means using the passengers to spend more money. And number two, you have to have the more offerings so that people are able to buy. So spend per passenger has to go up as well as the penetration has to go up. For that, we should make more comfortable passengers in the airport. So their entire process within the airport and after reaching the airport to get into SHA should be made more and more smoother. Further technology has been now working. Of course, DigiYatra is working, and we are also working in a lot of technology-driven initiatives so that the passenger feel more comfortable. Because otherwise, passenger are always anxiety that he wants to reach the gate.
Yeah.
So you should make him more comfortable, saying that don't worry, the gates you are able to enter in SHA, gate is not far away. Then we should give a lot of comfort to them to spend within the terminal. So that's why we have been working on that direction, and we are hoping, and we have seen a good trajectory in that direction.
Understood. So you have broadly highlighted two things. One is the strong pipeline of the aircraft orders, and second is the passenger satisfaction related approach, so that can and higher offerings, so that can lead to the monetization of the non-aero revenue. And 10 to 11% growth is quite reassuring. So thank you for the same. So now may I request Mr. Ray to join here for the views. So as mentioned by Palak, there is a huge capital outlay of around 1 lakh crore expected, mainly for the brownfield expansion over next 5 years. So that will lead to the debt requirement of around 70 to 75,000 crore. So in your opinion, is there adequate investor appetite to fund these opportunities?
So if you look at not just capital markets, you look at the bank loan market. The bank loan market is somewhat starved of good issuers who are willing to borrow for large amounts, who are decently rated. Even a starting airport, a greenfield airport, can maybe start with some kind of rating like A or so. And we have seen that a mature airport gravitates towards AA, and in some cases, depending on the parent, can even go to AAA. So there's a very strong loan appetite. Added to that, we have a decent number of infra NBFCs. We have seen that the power NBFCs are getting into infra financing as a diversification. We have seen that NABFID has come in as a large entity which is looking for assets. We have seen that the IDF NBFCs can also take out some of the operational borrowing of airports. So there's a sort of a juggling of limits all around the sector. You have certain entities who have given loans, who might be taken out, who might give a fresh loan. And on top of that, with the migration in ratings towards AA minus, AA, AA plus, and so on, we have to see, when insurance and pensions come into this sector, they have been evaluating it, and that's possibly an answer to a separate questions. And in the background, we have seen that there have been large issues much earlier when even dollar bonds were floated. So overall, the size is high, but the investor pools are also large. It should be matched.
So quite insightful market perspective, sir. And you have also brought important points of widening of investor class, which can capitalize this conducive regulatory environment and a favorable sector outlook opportunity.
It is
So
already
thank you for
happening,
that.
Maulesh. It is
Yeah.
already happening.
Yeah.
So
Yes.
when we go for any refinancing, IDFs are coming in a big way.
Hmm.
They are taking up the entire loan book. They are very much interested because they are long-term investors.
Hmm.
So the new institutions like REC, PFC, and NAFID, they have already come forward. For example, REC has already funded us in case of Goa as well as our Bogapur airport. Even in case of Greenfield, now they are coming in a big way. Yes, there is a good appetite available. I agree with what Shameek says.
Yeah. So it's quite promising. So, Mr. Tiwary, I would like to invite you here. So, as seen in the presentation, the sector has witnessed uptick in the non-aero revenue per passenger. However, if we look at the non-aero revenue per passenger and we compare with some of the global airports, so they are still at a 2x of Indian airport. So, in this context, what is your growth expectation for the non-aero revenue in the medium term? That is one. And what are the top three drivers for monetizing the non-aero revenue opportunity?
Yeah, I mean, that is one of the most important revenue earning piece for the airport business. So, see, as per our own assessment, Indian airports are expected to witness a strong double-digit growth, uh, somewhere around 15 to 20% CAGR in the non-aero revenue per passenger over the medium-term period. I mean, that's what we are assuming, and it is basically being driven by rising disposable income. If you look at the way the disposable income is rising every year, we are presuming close to between 25 to 30 million people are coming out of poverty. And then the increasing passenger footfall, I mean, the way the increase in uh, terminal capacity of airport is getting increased and the enhanced airport infrastructure. So these are the basically uh, now, even if you take care of the current non-aero revenue growth, it is close to 50% of what actually it is there globally best class airport which is there, which indicates that there is a significant headroom for the expansion. Now,
Absolutely.
this gap can be bridged close to 60 to 70%, driven by structural improvement and evolving consumer behavior over a period of time in the next at least 3 to 5 years period of time. That's what we are pre-assuming. The key drivers, to the best of our understanding, in terms of monetizing non-aero revenue will be, first of all, growing passenger traffic and the rising affluence. So, I mean, the Airport Council International has already said that, and they have done a study that if the passenger growth is by 1%, then the growth in terms of non-aero is from 0.7% to 1%. So, in case of Indian parlance, see, currently, when the CARE showed the presentation that it is supposed to grow at a rate of between 9 to 10% annually, with more middle class travelers who are going to spend more on the premium experience. I mean, that is what is going to be one of the most important, a driving force. And this is happening because the disposable income and the evolving travel habits, which are getting boosted up. These are one of the most important criteria. And then the second point, which I think is primarily driven by digitization and data-driven personalization. the way the private airports basically, and in general private airports,
Yeah.
even public sector airports they have all started into terms of utilizing airports at how they can leverage the digital wallets, AI based recommendation, and omni-channel shopping in terms of say pre-ordering and internal delivery, etc. And at least I know about two prominent airport private operators. They are into developing their own app, creating their own digital platform in terms of enhancing the conversion rate by offering targeted promotions. And the third important point which is going to come is the duty free and duty paid expansion, which is on the card. So currently, duty free spending per passenger in India is close to 40 to 50% lower than the global peers. I mean, and that is where there is a scope. I mean, if you can expand your premium liquor and luxury brands, there are localized products which can command higher spending. So these are the potential area for the duty free part. And then, I mean, there are other points also in terms of premium lounge and hospitality service in terms of where the private airport and also the public sector airports have started focusing on to luxury lounge, VIP experience, co-branded offerings with the banks. And then the things which are coming from integrated commercial real estate development, which is yet to get monetized in terms of the Indian airport parlance. So if you look at the way uh, the global airport scenario is that close to their 25 to 30% on an average of non-aero revenue comes from hotel, convention center, office space, and malls. These are the four main prominent area. Now, this is where, I mean, GMR definitely has taken a very strong leap in this, but other airports are lacking behind, and there is a huge scope which is available for the other airports also to catch up and to take part into this kind of growth which is there. Then every sector, every point of non-aero revenue, I mean, that in terms of advertisement, the touch-based advertisement which is coming, the 3D experience which is there, strategic tie-up and partnership with the different service provider. I mean, the premium valet services. So, see, these are a lot of enablers which are there in terms of the non-aero revenue, which is going. See, currently, I mean, at some of the airport, close to only between 20 to 25% of the travelers, they touch base upon one of the total services which is being offered, either car parking or lounge or duty free or duty paid or whatever. Take all the services and close to 25% of the passengers that touch base upon one of the services. There is a huge scope in terms of, I mean, at least the of all the services which is being offered, at least the passengers should avail one service. That should be the target of all the airport operators, and then that is at least going to increase lot of non-aero revenue going forward.
So it's quite interesting. So broadly, to simply put out this thing, so you have said that you are expecting around 15 to 20% CAGR growth in a non-aero revenue, and that is
I mean,
linked.
yeah, that's an understatement. I mean, if the cards are played out well, see if you look at the way the number of income tax filing is increasing, and even into that, and I'm not taking now. I mean, definitely it is going to go down because of the new regulation. But if you take care of the way it has been increasing in the last 5 years, if you look at the way number of people who are coming out of poverty zone, if you look at the way the GDP per capita income is rising, if you compare India scenario with say Brazil or with, so forget about China, compare with Brazil and Mexico in terms of spending on holidays, travel, tour, and retail. I mean, Indians are spending far less than what these countries are even spending. So there's a, and with this middle class income rising, disposable income going up, people having more money into their hand because of the new taxation policy which has come, which has enabled people to do more expenditure on all this. Because the vulnerability, see, more income goes into the hand of the people, vulnerability goes down, and that generally propagates people to do a lot of expenditure. So 15-20% could be an understatement.
Okay. Okay. So key drivers are the rising disposable income, evolving travel habit, then digitalization and focus on the premium products in the duty-free segment. And then lastly, you said the strategic tie-up to attract the more services from the customer. So these are the broad points we have highlighted. So now my follow-up question is to Mr. Babu. So, as Mr. Tiwary has mentioned, the factors related to the passengers and the economy, macroeconomic factors that can lead to this growth. Another point you have initially mentioned is the because of the new arrival of new aircrafts in the pipeline of the delivery, there could be increase in the international traffic in India. That also mentioned in our presentation that international traffic is expected to outpace. So then, is it a possibility to have a more transfer traffic? Because transfer traffic has a direct influence on the non-aero revenue. So how do you see the transfer traffic opportunity in the various airports in India?
Maulesh, when it comes to the transfer traffic, I think we should first understand there are three types of transfers. One is the domestic to domestic transfer is also happens. One is the domestic to international, then international to domestic, and international to international. So when you look at it, the transfer pack, for example, take the Delhi, which was started with 4%, 5% when we took over in 2006. Now we have a more than 21% transfer packs. And Hyderabad has already touched more than 24%. Of course, it is sudden jump because of Indigo is doing a lot of transfer at Hyderabad. So transfer packs, absolutely right. They spend more time in the terminal and we should able to monetize them. And that is where I pointed out in the beginning itself that the offerings should be more and make them more comfortable. And that is where it uses for the penetration. Penetration is very, very important. And penetration goes up and offerings goes up, then your spend per passenger goes up. So we have been working on that. And transfer packs, we expect to continue to grow. And especially now we have started looking at Delhi, which is a small number, international to international. So people coming from east and Delhi is becoming a hub and going to again to the west and otherwise European market. So we have started looking into that and it has already working out a small number. So transfer packs is going to play very vital role. And we are cognizant of it. That's why in our expansion, we did a lot of area has been created for the transfer packs. And a lot of thrust we are giving it, especially in case of domestic to international transfer, that helps us to have a more and more sale. And also international to domestic, also people can buy the products at our duty-free shops. So the offerings are going up. We are expecting a much more growth in case of non-aero. Of course, it all depends upon the number of outlets, pricing, and we always ensure that the prices, when it comes to the retail, it is equal to downtown. When it comes to international, especially duty-free, we are trying to match the prices across or competing airports like either Dubai or Singapore or Hong Kong. So we have been ensuring that and assuring the passengers so that the sales goes up and spend per passenger goes up. So that is where we have been there. And transfer packs continue to grow in India as long as now Government of India is making the both Delhi and Mumbai as the major hubs and Hyderabad and Bangalore as the secondary hub centers. So as long as that objective of the government is moving forward, airlines have been operating in that direction, transfer packs numbers keep going. It will reach maybe over a period of time around 30%.
Understood. So now we got the clarity on the non-aero revenue potential from the passengers. So now moving to Mr. Tiwary on the potential of the non-aero revenue from the non-passenger. So as you initially mentioned that the city-side development revenue that in globally constitute around 25 to 30% in their overall non-revenue share. So how do you see this potential in India, and what are the key challenges? As you mentioned that monetization till date is not significant. So what are the challenges and opportunities in this segment? You are mute. You are mute. You are on mute, sir. Mr. Tiwary, you are on mute. Okay, I think he is on work. Something else has come out. So we have started with the our outlook on the passenger traffic, and Mr. Babu has mentioned the double. Yeah, Mr.
Sorry, I think
Yeah.
someone muted me from the panel, so I couldn't. Am I audible now?
Yes, very well.
See, what I was saying is that in terms of monetizing the non-passenger, this is one area where uh, the airports in India are lacking. Now, if you look at the way, say, airports like Changi or Dubai and Munich, they have successfully expanded their non-aero revenue beyond passengers. I mean, what they have done is that they have made their airport destination hub for local tourists and businessmen, and they are being rewarded for that also. So Changi, basically they are earning close to 45% of their revenue from jewel. I mean, in terms of whatever it comes from the retail, entertainment, and real estate sector. Similarly, if you take example of Munich airport, I mean the airport city which Munich has developed, it contributes close to 35% of the total revenue, which is coming from them. India, basically, we are relying on passenger footfall, I mean, non-aero revenue, etc. But there are certain airports, definitely Delhi and Mumbai and Bangalore, where there is a significant potential of widening the revenue base for the non-passenger. I mean, and the thing which can be taken is like you can develop mixed-use retail estate. I mean, retails and malls and convention centers and hotels, uh, so that you can attract local footfall for shopping, dining, entertainment. You can create co-working space, commercial offices hub near the airport, and then you can also like the cold play which has currently happened. You can that shows the immense potential of the cultural event which can, and the concerts and the exhibition which can
Yeah.
happen. So what I believe is that if top 5, 6 metro airports, if they are able to replicate Changi's dual model, then what is going to happen is that in all the aspect, like in terms of your retail, food and beverages, and entertainment, and office space, and hotels, and convention centers, and concerts, and events, etc., there can be a substantial gain in terms of the revenue which is being earned. I mean, that is what the potential we are talking about. And slowly and steadily, the airports have started taking note of it in terms of developing premium malls and luxury shopping zone. Let us not go that far. Chennai Airport, the way they have developed their uh, what do you call it, destination kind of thing outside their airport, the Chennai airport. In terms of, I mean, the dedicated entry, they have done it for the non-passenger shoppers, which is linked to your, I mean, and they have also, I think, started last when I visited. I discussed with them. They also have dedicated entry for not only dedicated entry, but they have also started the pre-booking. Then there are options of involving for high street dining, food courts, and then entertainment and thematic attractions like Changi. So there are a lot of opportunities which are there in terms of how the people, how the airport operators can interact with non-aero passengers in terms of increasing their revenue. I mean, there is a huge scope in terms of how do they can take it. I mean, see, one important thing is there, and I can give you example of Sydney Airport. If you have to drive to Sydney Airport, you keep on driving to the airport, and you will see the development which has been done in and around the Sydney Airport on both the side of the highway, and you will see suddenly you enter the airport. So the airport has been imbibed in such a way with the city that it is not only providing facility to the passengers but also to the non-passengers. And that's why this transition, if it has to come from for any airport sector from transitional air travel hub to integrated airport city destination kind of thing, then this setting of this benchmark as a global airport monetization is a must. The way it is there in Sydney, Changi, Dubai, Munich, etc.
It's quite interesting, and thank you for bringing this concept of bringing the integrate the airport with the city, so to tap the opportunities. So all in all, the opportunities are there, albeit with the challenges in the implementation of those strategies. So now I invite Mr. Ray to come here. So, sir, based on your vast experience across various transactions, what are the key parameters that influence investor decision in the airport sector?
I think that Comparison between the outlook 10 years back and today will be a good sort of take on what has changed. 10 years back, the airports were more into greenfield expansion. Now they're into brownfield expansion. So at that time, we were a bit early to market. I remember working on some transactions around 2015 or so. Infra was still a bad word. I think infra today is a decent word and actually deserves to be a better word, except that we have very long memories and we recall mistakes which we made lending to the wrong promoters in the wrong sector. And the government did not have stable policies. So possibly some of those come back to us at nightmares once in a while. But the greatest change has been that the government policies have worked. The policies which they have set up for airports has been seen to be stable and useful. The airports are making profits. There was a lot of apprehension about these 5 year periods in which the ERA orders would get refreshed, about the true ups, how they would change. Possibly since 2014, we have had 2 cycles or 3 cycles for every airport. Investors do note that whatever apprehensions we had seem to have been addressed over a 10-year period. They also note that there are a number of lenders to sort of take up the load. It is not just banks. I'd referred to IDF NBFCs, private sector NBFCs, PSU NBFCs. So I think that capital market and investors look at the possible liquidity. And sometimes, if you look at mutual funds, for example, they do lend for 10 years or 15 years, or they'll even take a 40-year government security, but they need liquidity. So what happens is, as more lenders come into a sector, you feel that the impact cost, if you have a decision to, let's say, sell a certain credit, you see some rating volatility in that sector, or you see some rating volatility in that particular credit, or you just want to book profits. You have invested at a good rate, you want to exit at a good rate. You see that there are more lenders. So therefore, however good the credit will be at a time, at the start, there are fewer lenders and they are mainly project lenders. When that credit has established itself over 10 to 15 years and there are more lenders, people take comfort from the crowd. So I think that it still remains a fair amount of brownfield project risk, but that is a lesser risk for lenders. If there are negatives, I should also mention them to give a balanced view. There are still possible negatives on tourism traffic, though we have seen that business traffic, commodities traffic, goods traffic, etc., has remained stable. We had the Agni Pariksha of COVID, and we found that in some ways that the sector and the sector regulator, what happened in roadways with NHAI similarly happened with airports also. Things were stable. But tourism traffic can be up and down depending on how India is viewed as a inward destination, how certain sectors are viewed as an inward destination. We still have some uncertainty amongst non-project lenders about what happens when a new airport comes in near an existing airport. Of course, we know that existing airports can have ROFR rights, or they can have exclusive rights for certain periods, or that existing airports have scaled up a lot by the time the new airport comes in. But possibly capital market investors will look to see how one or two of these cases happen. And as these happen, they will take some greater comfort. We also see that certain investors do sometimes give a undue weightage because they look at the downside, they don't look at the upside. They are there just to ensure their capital comes back safely. Undue weightage to upcoming maturities, upcoming refinancing risks. As the scale of the airports is growing larger, while there will be certain periods when they will be doing very large investments, their cash flows have become stronger so that they are able to manage these refinancing risks more efficiently. On a very important basis, if you look at the promoters have become stronger. They have larger balance sheets. They have diversified across a number of airports in some cases. They have listed their airport holdcos in some cases, or they have, there's some capital history track record also. So the ability to run equity, bring in equity is a very strong determinant. We've even seen some promoters possibly get change that a stronger promoter has come in case of a weaker promoter. So the sector looks better now. Of course, there will be uncertainties if there's a high capex, if there's a high UDF. Will we have competition from trains or other modes? If we do have the bullet train coming in, uh, if Gujarat, Ahmedabad, Bombay works well, will it be there for other geographies? Those uncertainties will be there. But by the time that comes in, our airports will possibly be more well established. And the UDF is a cyclical thing. It goes up for some time and then again it goes down. So hopefully, airports will be able to will be able to borrow for longer periods. They will be able to borrow at fixed rates. If this happens, longer tenor borrowings and fixed rate borrowings, it inherently de-risks the credit to some extent.
Yes.
So possibly, we have a good future ahead. If we see more of deals, the existing deals we have seen, the rates have been coming down. So more credits in the market, more competition, better rate for issuers.
So well articulated, Mr. Ray. So broadly, you said that because of the mature tariff setting process and the conducive regulatory environment, so that has bolstered the investor confidence. However, the some of the risk side is the some mine capex related risk and also risk of alternate mode of transport. So that needs to be monitored. So these are the broad things, and your response does echo with the outstanding credit ratings that we have for the airport sector. So, yeah, so moving to the discussion on the emerging topics. So beginning with the Mr. Tiwary. So as seen in the presentation, the air cargo is expected to grow at a healthy rate due to favorable government policy as well as the first on the multimodal logistics. So how do you see this air cargo growth potential in India?
Uh, See, cargo is one of the most subdued business, and but that was one of the business which was savior to all of us during the COVID time because that business kept on continuing and kept on giving us revenue. See, the air sector in terms of cargo is poised for rapid expansion. I mean, from here, because of the few things, few enablers. One of them is, say, the favorable government policy. So, like Gati Sakti has come, and national logistics policy, and the air cargo policy, which I think was implemented, which came in 2019-20, the air cargo policy, and then the rising e-commerce and express logistics demand in terms of the e-commerce demand which is coming, and then one of the area where which is still lacking and there is a huge scope is the multimodal logistics, which is integration of rail, road, and ports along with the airports. And the way airports, basically the private airports and government airports are investing, and the CARE also said that in the next 5 to 6 years, close to 12 to 13 billion dollar of investments are going to come. So the infrastructure investment which is there. So I am highly upbeat about this multi-modal logistics integration, which is yet to take place. I mean, today these things are happening in silos.
Yes.
Air cargo. The time is coming because of this national logistics policy and Gati Sakti, where multi-modal logistics integration is going to happen. So that is one thing which is going to take which is going to push the cargo activity for the airport, and there is huge potential. See, uh, national I was highly upbeat about this national air cargo policy of 2019, which is yet to take into true shape, which targeted I think 10 or 12 million metric ton of cargo that is to be handled by 2030, along with the Gati Sakti scheme, and then the PLI scheme, which is also on the card, or I think it has come, which is the PLI scheme in terms of boosting the manufacturing driven exports. I mean, that is also going to be one of the most important thing. Now, if you take into account the aviation sector per se, then one wild idea could be the liberalization of the drone policy. So that could also help in terms of the express cargo market. In terms of the e-commerce, which is going to put up a lot of push in terms of the cargo potential, uh, the same day delivery model, which is there in terms of the Amazon, Flipkart, and Reliance Retail, and all the new ways delivery models which are coming, then definitely in terms of one of the preferred mode for them to use the logistics part will be air so that the time can be cut down. So from my point of view, all this aspect is going to push the cargo business. And if the airport is able to invest aggressively into the cargo infrastructure, they can establish, I mean, the cargo business as one of the leading cargo hub, developing the cargo hub and capturing the significant share of the boosting logistics market. One important thing today, if you look at the way India is positioned, I mean, logistics cost close to around 18 to 19% of the total cost as compared to 9 to 10% in the developed market. So there's a huge headroom for reducing the logistics cost, and even without increasing the overall cost for the final products, the logistics company can have a 9 to 10% gain coming out of that only because of the operational efficiency.
Yes.
That is going to give a lot of boost in terms of the cargo part which is there.
Understood. Yeah. So thank you very much for the same. So now I would urge Mr. Babu to share his view on the sustainability. So as you may be aware that the Delhi airport is amongst the first airport in Asia to be certified as a net zero in line with the Airport Council International's level 5 requirement. So what additional things according to you can be done going forward for enhancing sustainability by designing and constructing the airports?
So we have already got the level 5
Yes.
agreement. Of course, we have yet to reach the 2030 or target. This is basically we are meeting all the requirements what SC has imposed. See, if you look at it, what are the additional things that we can do to maintain the sustainability is basically the material sourcing, the construction, and the water harvesting, and waste management, and the transport solutions, as well as the green energy, totally procurement of green energy. These are the areas which you can continue to improve upon to make it a sustainable net zero airport. So we have been working on that. For example, in case of Delhi, if you look at it, none of the rainwater harvesting we do, and no is a zero discharge airport. No wastage of water outside. Entire water is recirculated and used within the airport. The entire wastage also has been converted to manual. So we keep on working on all these measurements, especially construction material, construction design, and they should become the green building in the initial stage itself. And that is where we will be able to, and we continue to.
Understood, sir. So, sir, my final question for today's panel discussion before we take the audience question is to Mr. Ray. So, sir, what are the advantages of domestic capital markets in funding of airports infrastructure? So, this is your experience.
Well, I touched upon this. It is definitely a question to look at again because finally our industries and our credits should be serviced by our capital markets. You get investor diversification, competition brings in lower rates, you get longer tenors if you can get in insurance and pensions, provided they feel that these are safer and mature credits. They are not so bothered about illiquidity, but they are bothered about credit migration not being there, credit stability being there, so that they can take a longer call. And if for any reason they want to sell, they feel that there should be other buyers who will always be there to buy at a better rate in case they're willing to sell at a better rate. And I think that the domestic markets also give you the advantage of no FX risk because overseas borrowing, which has advantages of deep pools of capital and larger transaction size, does come unless if you have some partial hedge from your sale of whatever from your overseas airplanes coming in or airlines coming in. The overseas bonds come with FX risk. I just wanted to bring another point, and I think some of the speakers mentioned that finally the airport, I think Rakesh mentioned, is a part of a larger system. When we speak to investors, we say that this is a product which you can experience yourself. You're flying in and out of an airport is in a way your due diligence. And you can see whether the airport has spick and span, whether it has been renovated, how much time does it take to check in and go, and how comfortable you are and how happy you are. Because in a way, I think that if the airports can keep the customers happy, they can take a higher take in a non-aero and other revenues. And if I'm paying a large, somewhat higher price for a cup of coffee, maybe I don't mind it if the ambience is good and the service is good and it has an upbeat feel, whereas I will definitely mind it if I don't like the ambience. So I see the stark difference between the private airports and the Airport Authority of India airports. And I see that certain states and certain cities and governments have realized that for whatever good or bad reasons, they could not privatize the airports. They want to catch up. So these are things that I think as all of us, we fly through airports and we give this feedback and think of this feedback, which comes into our credit opinions.
Thank you, sir, for
Makes
the.
two point over here, if I may. So first of
Yeah,
all,
yeah, sure.
definitely public sector airports needs lot of things to be done. But then okay, you can't blame them because profit goal and service goal cannot go side by side. So I mean that was the main reason why the privatization of airport started. But coming back, see the Indian domestic market today, and this is my personal opinion, is not very conducive in terms of the way the airport business is being funded. See, airport is a long gestation period asset with a high capital requirement. I mean, the Indian domestic market has not geared up to issue paper more than, I mean, 5 to 6 years. No one is interested in doing that.
No, we
So
have Rakesh. I think 10 years comfortably is happening.
I don't know. I mean, maybe GRK, you are comfortable. I mean, you may be getting it, but then 10 years paper at a competitive rate. See, airport, there is the regulatory risk and policy risks are well under control. The exit option is under control. It's a regulated entity, annuity-based payment, uh, highly monopolistic, but still the market, the financial market needs to develop in terms of uh, so the insurance sector, why it is not finding any space in terms because see we are the operator of the airport, we are not the owner. So the CB guideline, there is a restriction. Now there are people who are finding a way out of it, but then it's still the conduciveness in terms of supporting. So the privatization is happening, but side by side, what is required for the privatization, as Samik you rightly said, if you really want the feel good factor, then privatization alone will not do. I mean the promoters or those who are in the process of working in the airport, their hands need to be strengthened so that they can really build world class airport.
Yeah, I mean, you're right. The thing is that insurance sector is the only one, and insurance and is the pension funds, which have got a very deep pockets, who can give, as Shamik said, that a long-term debt. They don't look at the liquidity, but they look at it the more credit profile. They are, I mean, inching towards maybe in a year or two, or maybe in another 2 to 3 years, they will also come into a big way. The moment they see there is a good asset which is available, which is giving the return. But as of today, the investor base has to be widened, and it is getting wide. When we started about 4 years back, the domestic market paper, it's a very restricted number of investors have come. Now it is much wider and it is growing, uh, but it is not as deep as international, as Shamik said. International is too big. And the only thing is you have a forex risk is the one, and that we have to take care of it by doing a proper hedging facility. The only thing, including the pricing plus hedging together, is it making a sense, the pricing compared to the domestic market is the criteria. Always we look at it. Wherever it is feasible, wherever we are able to reduce the cost, because regulator is very, very particular. The regulator makes it very clear if your pricing is international borrowing, if you are doing, if the pricing is more than the domestic pricing, he is not accepting it. He is restricting it to only domestic price. That's why we are working. I mean, the market is evolving. I think I am able to see a good future. Let us hope for the best.
Okay. So it's a quite insightful discussion covering both developer and investor perspective. So now we'll start with the Q&A. So the first question is with respect to the non-aero revenue. So how joint venture can play the role in enhancing the non-aero revenue is the question. So Mr. Tiwary, can you take up this question?
Yeah, I mean, joint venture will definitely play a significant role in developing the non-aero revenue. You have to understand that airport operators may not be expert into anything and everything. And we also need to understand that, first of all, the business of the airport, running the airport is not a single business. It's like you have to take care of the core business of the airport where you have to be fully involved into aero operation, which is one line of business. Then non-aero is another line of business, which is a highly consumer facing business. And then there is a CSD business, which we call it real estate business. And then there is cargo business and fuel farm business, all combined into one place. And every business has got its own way of working, and individually if you look at every business is like a different line of business altogether. So definitely joint venture partners who are specialized into different areas, say car parking. There could be car parking people like say Park, it's an app, I'm just giving a random name. They are the ones say who are specialized into providing that kind of services. Say in terms of any particular cargo business, say we are talking about multimodal cargo activity which is required to be done in terms of how do we stitch. Say a Maruti car has to travel from say here to say Israel, then how from Manesar plant the Maruti car will travel, which taking into help the train and the roads and the aeroplane and then the seaport through which it has to travel. There will definitely be joint ventures who will be there into different line of businesses who will come up with their own expertise and provide the services. Similarly, in terms of the other activities of the non-aero business, say there are people across the globe who specialize into providing lounge services. I mean, and if you take their help by forming joint ventures, by asking them to become your partner in terms of the kind of expertise they bring in, world-class service experience, it is going to create a win-win situation for everyone, for the joint venture partners because they will definitely be a part of the growth story, for the airport operator because the airport operator will be able to provide world-class service to the incoming passengers and also to the passengers because they will then get a feel of how the world best airport kind of gets the services in terms of say lounge or in terms of F&B or in terms of duty free. So the curated services which was required in terms of offering to the consumers, definitely joint venture partner is going to play a very big role, whereby you don't have to start dividing your concentration into different activities and different line of businesses.
Okay, okay. So there is one more question with respect to the bond market. So Mr. Ray, if you can answer. So the question is in general, in infra perspective, what all should be done to deepen the bond market appetite?
I think that what has been done in recent times should continue, that there is stability in the policies from the government. Uh, there is stability in the models. The models are such that it brings in promoters who have deep pockets, who are able to see a viable line of business where they will make good profits and they are willing to invest large amounts of money. The model should not be such. If I look at the road industry, how it was maybe 15, 20 years back when we had fly by night people coming into the road industry. So I think it starts with the models that we bring in the right kind of promoters. Once we have brought them in, we have stability of the policy. And if any shocks happen like COVID or anything else, they are dealt with in a very positive way so that the investors are happy. And after that, I think investors have to step up also and realize that good work has been done on the promoter side and the issuer side, provided their concerns, because they have always have legitimate concerns on the covenants and so on are met. And these will be met if they provide the right rate. then it's, are they providing the right rate and the right amounts so that the promoters and the issuers are willing to partner with them? We will have volatility here and there. We will have problems here and there. But I'm positive that with so much effort and so much, let's say, good examples we have set, maybe things will not change today or tomorrow. But as Mr. Babu said, in a year or two, we should see that maybe more investors come in. And let's not be in a hurry to do it, because if you give time to investors and they come in on their own, possibly they're going to stay with us.
Quite insightful. So, my last question before we end this session is to Mr. Babu. So, the question is from with respect to the greenfield airport capacity. So, is there any expectation of a new big greenfield airport coming in next 5-10 years horizon, except for the second airport of Chennai as a twin airport in the major city?
We are not able to see right now. I mean, we are only constructing the greenfield airport in Bhogapuram right now, which is replacing the existing airport. And most probably will be going for the Nagpur is for expansion. Otherwise, we are only looking at the Chennai is a new airport which is coming up, but that is a second airport again. And Bangalore is also talking about another airport, HAL airport. They have wanted to start operations. Other than this, I mean, right now there are no greenfield airport, big airports. So at all, the AI is setting up, but they're all very, very small airports, about 1 million, 1.5 million traffic start. Otherwise, there are no major airports are coming up to our knowledge, except privatization, which government is talking about it. Other than that, no. But expansions keep happening, as you said, 1 lakh crore the next 5 years. Yes, the way the traffic is growing, there will be a substantial expansion again in the airports.
Promising. So yeah, so with this, we have concluded this today's session on the panel discussion. So I'm sure everyone would agree that we had a very engaging and insightful session today with our experts. And we all agree that Indian airports are gearing up for the smooth takeoff. So thank you once again, Mr. Babu, Mr. Tiwary, and Mr. Ray, for sharing your thoughts and answering all the queries of the participant. I am privileged to host you all. So thank you. Thank you very much. So handing over to Mamta for the closing remarks.
Thank you, Maulesh, for moderating the session, and Palak and Urvesh for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.